So I think when we look at the recent bank failures, there are two important points. In the short term, I think all of us are worried about increased regulatory scrutiny and what that actually means and what the scope of that will look like and how banks will deal with it. I think longer term, we'll see that some of the things that have been maybe retired or no longer required will come back. And what I mean by that is I think resolution plans are going to come back with a vengeance. And what's most important is to realize that those plans actually touch third-party relationships. And it's not just vendors, it's any outsourced third-party relationship. And so what that means is the procurement teams at financial services, banks, credit unions, community banks, they will need to ensure that they're having those heightened requirements met in their contracts. And that includes heightened due diligence, actual business continuity plans that allow for the transfer of services or the backup of services, ensuring that they have the right to test and to monitor those third-party relationships, and that the contracts support their intervening and taking back those services where they are required. I think that we'll start to see a heightened examiner reach out to the various banks. I think you'll see a number of exams expanded. And then I think that the banks really do need to take hold of this because of not only this current regulatory pressure, but we were already expecting joint guidance from the bank regulators in the US dealing with third-party relationships and how the banks are going to be required to manage those. So I think in the short term, it's the worries around the regulatory scrutiny and what that actually means. And I think longer term, I think we'll see more regulatory guidance. I think we'll see more exams, and I think we'll see actually an increase in the activity around compliance for most of the banks.